In this video, traders, we're going to look at the trading strategy called the second day reversal trade. One for swing traders. Stay tuned. Hey traders, a very warm welcome to you. Thank you for tuning in to the channel. Okay, so one for swing traders out there. This is on a daily time frame. It works very well with indices, but also works with currency pairs, cryptos, and stocks if you're using a decent liquid stock. Right, so the idea behind this trade is that we have a trending environment and we're looking for a one-day movement against the trend, a second-day movement back in favor of the trend, and a third day will be our trigger day that we enter the trade. Now, this is one that I've dug up from the archives, the old textbooks, the kind of ones you dust off and go, oh, let's have a look at some of the old school strategies. This probably works quite nicely today. However, I would suggest it may be a day trade, as in I would say a day trading strategy. It's one for the swing traders, but it's one that probably is for kind of 1 or 2 days rather than hourly or 5 minutes, which I would define as a day trader. It's really for that 1, possibly 2-day play with some added filters in. Let's have a look at the rules anyway, and we'll talk about it some more. All right, so the rules are this. Day one, the stock or the market closes in the lower 25% of the range. So this is day one here. This is our bar. Range high minus low. We're looking for the close in the lower quarter. So it's got to be the lower quartile, either 25% or lower. So right on the low or up to 25% off the lows. Easy to screen for, easy for us to eyeball as well. Okay, so that's day one criteria. Day two, the close must be in the upper 25% of the range. So we have day one, the close in the lower. Day two, we've got a bit of a change in momentum. We've got a close in the upper 25% of the range. That may sound all well and good. However, how do we filter for the trend? This is where we're coming with rule number 3. The day two close has got to be greater than the 10-day moving average and the 50-day moving average. So 50 days giving us that swing trading filter of, hey, we're reasonably bullish. By the way, this is for long. Flip on its head for short, below, and obviously short if we're going short. So that gives us our kind of broader filter of, hey, this is reasonably bullish over our 50-day period. 10 days is actually quite quick. If you've ever looked at a 10-day on a chart, a 20-day is reasonable, 5 is really super quick, 10 days quite quick. So that's going to filter out really stuff that's pushing to the upside, especially, you know, maybe day one has come below it, but day two is above it. But the 10 is really going to be in line with a decent trend. You're not going to get this triggered with anything that's in a slight downtrend using a 10 day. So that's a nice filter on that. So we've got our filters now. We've got our kind of trend filters, if you like, using the moving averages on the smaller, on the lower and the higher numbers. We've got this movement against the trend on day one and the close at the lower end of the range of the day. Day two, the reverse of the close in the upper end of the range, the upper quarter. Got those filters. Now, how do we take the trade? We take the trade, we go long above the day two high. So assuming we're day three here now, this is our long entry right here. As price pushes above that, bang, we are in. At the high plus a few ticks, that could be 10 pips if you're trading, 25 pips. You're gonna have to adjust that based on the volatility. If you're trading cryptos and they're quite volatile at that time, use a decent, a little bit wider kind of entry. You don't want to be, the point is you don't want to be getting in just when it just kisses above and a bit of noise. You want it to be clearly above, but not too far above. So that could be kind of 10 ticks, 10 pips, 20 pips, 30 pips, depending on that kind of volatility. You don't want 100, 200 pips because the average range of the day might be 100, 200, and it's pointless. You just want a little bit above. So there's your long entry, and your stop, you're going to have your stop at day two low minus X ticks. And X ticks, again, I would say use, you know, the same kind of number that you've used for long. So if you've gone long at the high plus 15 pips, for example, your stop's going to be at that day two low here minus another 15 pips. There is going to be your stop. So you've really got the range of the prior day as your stop. Now, that might be quite large, actually, depending on the type of day. So you've got to decide whether you want to take it or not. The point is now you're looking for that day three to push back to the upside, assuming that this is will have done this beforehand because your moving average filter will have filtered out anything but this. You're going to have pushed up. You've got that 1 day kind of pause. The second day pushes back up. The third day, bang, you're in. You're looking for a continuation of that trend. Now, this is in the book. It mentioned that one of the things that this guy liked to do, and I forget the author of this one, but this is a kind of strategy that you've quite a lot of people use. So I don't think this can take credibility for this, but The idea is that you close it on that third day, so you're trying to look for that momentum expansion. However, you can add additional filters in that say, hey, if this is at a 2-month high or some kind of high point, you can hold it for another 2 to 3 days looking for that further move. If you're kind of in a broader range, you've got to grab that 1 day, bank it, grab 1 day and move, put it in your pocket, move on. If you think this is going, much higher, we're kind of at 52-day highs, 2-month highs, whatever it may be, then you can look for that further multiple move, dragging your stop up as you go. All right, guys, that's the 2-day reversal trade. One to check out, one that's quite interesting, one I quite like because that supply-demand balance just shifts for a second, 1 day, bang, you're back in it, and using that as a filter to get in, using that as a good trigger to get in, and quantifying a risk, which is always the good sign of a good trading strategy. Let me know your thoughts in the comment section below on that one. Thumbs up if you like this kind of stuff. I'll see you in the next one, guys. Take care. Bye-bye.